We've heard it all and we have seen it all. And with the rise of social media, especially TikTok, there are a lot of people out there that are perpetuating myths about the infinite banking concept. And so today, Anthony and I are going to be sharing our top 3 myths about infinite banking. Stick around.
Enjoy the episode.
Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host, Anthony Faso. And today, like I mentioned, we have heard it all and we have seen it all. And today we're going to be sharing our top 3 myths of infinite banking. And as normal, Anthony has his and I've got mine. So we're going to be sharing 6 of our favorite myths of infinite banking with you guys today. Anthony,
go ahead.
That's just, I was going to say, I know you're excited. Chomping at the bit.
I am. I'm excited for 2 reasons. For one, some of this kind of pisses me off when I hear these myths, you know, but I'm also excited to be able to shine the light.
Oh,
right?
Shine
the light on infinite banking. And I'm curious, maybe hopeful.
What?
I'm hopeful your 3 are going to be similar to mine, because I picked like the top 3 myths. And I'm wondering, are you going to continue to have 4, 5, and 6, or maybe, you know, maybe there's one that you got right.
Maybe.
So I'm excited for that too.
Yeah,
so this is going to be fun.
Yeah. Without any further ado.
So let me hear yours. Now, do you have them in any particular order?
No, they're not in any order, as I don't look at this sheet. This one came to mind really quick, but to be honest, going through this and writing down some of the myths that we hear and listen to about infinite banking, man, I came up with a 6 or 7 really quickly, pretty easy.
I came with like 8.
I came up with 9, and it was actually tough to pare it down. And so there were some of them that were really easy, and we may have talked about them before on the show, so I crossed some of them off. But a couple of them were just so egregious that I had to share again.
Okay.
Right. So the first one I would say is that the biggest myth that's out there is that whole life is a terrible investment.
Okay.
If I hear somebody refer to whole life as an investment one more time, I'm going to slap Anthony.
Slap me.
Yes, I'm going to slap you. So, right, there's a couple things in that, right? People always referring to whole life insurance and they're saying it's a terrible investment. And I would agree. We would agree with that. That whole life insurance is not an investment. It is a cash management system, cash management tool that allows you to go do all these other things with your money. So we're looking at it for characteristics of certainty, safety, and control, collateral, all those pieces that come along with the cash value part of whole life insurance. And so that's it, right? So that gets me fired up. And as I was thinking about this one, I did have a quote that kind of came to mind.
Are you quoting me or?
No, I've always had this quote. Now, maybe I'm just forcing this one. I don't know. Yeah. You tell me, right? But the quote that came to mind was, I remember a gentleman was telling a joke about Groucho Marx. Okay. I don't know if you know who he is. He was a comedian way back when. Yeah, you should.
I saw him. Like, no.
But the story goes that Groucho was walking around New York City when a gentleman came up to him and asked him, Groucho, how do you invest your money? Groucho answered, all in bonds. And the gentleman said, but Groucho, they don't pay much in returns. He said, they do if you have enough of them. And that's the way I think of my policy, right? Listen, the returns are not going to be groundbreaking at all. But man, I'll tell you what, if your cash value is big enough, those returns look pretty darn good over time. So again, that's my first myth, is that whole life is a terrible investment. It's not an investment. It's a great place to store cash. You're going to get a good rate of return on it, and that's it.
Well done.
Thanks.
That is a myth that does fire me up. Okay. I didn't put it on the list for twofold. For one, because I thought you were going to, and I wanted to add more. Yeah. That I did have that on there, but I'm like, yeah, you know.
I can see your notes. It's not on there.
It's not. You can't see my notes. I actually password protected the Word document. I named it password protected just so you couldn't or wouldn't try. But I tell you, when I was going through this list, I started thinking of all the things people told me when I was trying to do my research on infinite banking. And that was a big one.
Mm-hmm.
And really, what I would add, you're right. Your policy is not an investment. This is a savings tool, right? But which will allow you to invest. We often say that this isn't an either or, that this is an and asset, that we can, whatever investment you're chasing or want to invest in, we can prove to you mathematically by running it through a policy, it's going to improve your returns and lower your taxes. So great job on that myth.
I was wondering if that was yours or mine. You just kept on going.
Well, no, it was good. Like, it's a good myth. I'm giving you a
Oh,
compliment.
well, thank you.
Okay.
All right. Drum roll, right? Anthony, what is, are yours in order?
In no particular order. They're all good.
Okay.
So it's like it's like one and then one and then one.
Gotcha.
Kind of the deal.
All right. We'll start us off with 1A. We'll see how it goes.
But well, maybe this one kind of, as far as a favorite goes, that's kind of what we were looking at. Or the one that kind of fires me up the most is the myth that I made $70,000 by financing my Ferrari through a policy.
Great one. Yeah, that's good.
I was going to say that for the last, but when you did the intro and you mentioned TikTok, I'm like, I'm going to go ahead and jump in case. Did you have that on there on your list?
No, I did not.
Okay.
That's a good one. That's a really good one. Yeah.
Well, what I will say, great video. It's like, hey, I just bought this Ferrari, and by doing so, my cash value increased $70,000, which my first reaction is like,
damn.
Heck yeah, let's do it.
I want some of that.
I mean, Ferraris really aren't my thing, but I mean, you throw in a Range Rover, or those new Hummers. Have you seen the new Hummers?
No.
They look, yeah. So I'm not really a car guy, but I mean, if we get two Hummers for the Ferrari, I mean, but then when that initial reaction goes, like, it kind of sounds weird. How can you create wealth by buying depreciating assets? I mean, so that to me just doesn't make sense, right? Which doesn't mean it's untrue. What it means is we need to dive in a little deeper. And I will say, in essence, what he said is that his policy, his cash value increased $70,000 during the time that he had financed his car, $70,000 more than what he had put into it. Not arguing that it increased $70,000. What I am arguing is the reasoning of that increase was not because you used it to finance a Ferrari. That's just how these policies are built. It would have naturally grown 70,000 whether you use it or not, because we need to remember the main reason why we're using life insurance is because we have the ability to borrow against it. So when we use money, whether it's to buy a Ferrari or a fourplex, we're not using the money from your policy. We're simply using that as collateral, and we're borrowing from the investment arm of the insurance company. So that 70,000 was an increase, was not directly related to buying a Ferrari. And one thing I thought was interesting, and again, I'm looking at the numbers. He said the Ferrari was $206,000, and the monthly payment was $2,700 for 5 years. If you were to multiply 2,700 by 60, the total is 162,000. Now, I don't know. I mean, I don't know. I mean, maybe there was a mistake, or maybe there's some a missing piece, or maybe I misunderstood it.
Maybe there's a rounding error.
Yeah. And what I'm saying is, you will see this a lot on some other people talking about infinite banking, that using this is gonna just create wealth out of thin air. That's not how it works. And what I will say, I don't think it's intentional with some of these people are myths that they're spreading. I think they don't fully understand it. So I don't think there's any ill intent, but at a certain point, if you're going to throw some content to other people, I mean, there's an obligation to make sure we're framing it correctly.
Well said. Well said.
All right, Cam. So what's your 4 or 5? What's the fifth best myth about infinite banking?
My second favorite myth that's often perpetuated in regards to infinite banking is actually the rate of return on a policy. When you hear about someone communicate that to clients, right? Maybe it's on a TikTok video, maybe it's over a short, something like that. What I will tell you is that a large majority of the time, it is either way overstated or it is way underestimated, right? So it's always the extremes. And, you know, on one end, you'll hear people say whole life is terrible. Policies don't accrue more than a point each year. And then in the other end, there's a gentleman out there that is out there telling people that policies will accrue at 10%, 6% plus a dividend, right?
Oh, yeah, I forgot about that guy. Oh, yeah.
Yeah,
that's a good one.
He knows who he is. Yeah. Again, that's just, I would like to attribute it to a lack of understanding. Guys, that is not how a policy works, right? If you look at it, there's two ways that a policy is going to grow in value. One is you have a guaranteed column on your ledger. And again, there's a lot of confusion that surrounds that guaranteed rate. One of the best ways that I've heard it described is that it's actually a reverse amortization schedule. And what I mean by that is that if you understand how a policy works, that your cash value has got to equal your death benefit at maturity. Then you can realize that, hey, that cash value has got to increase on a consistent rate every single year, all the way out typically to age 100 or 121. And then you can see that gradual increase. So a lot of times it's referred to as a guaranteed rate. But if you just understand it as maybe a reverse amortization schedule, that will help a lot with the understanding. So you have this accumulation on the guaranteed side where that cash value is trying to meet that death benefit at age 100. And then additionally, what you have is you do have dividends that are paid out every single year. What I will tell clients is that dividends fall under the non-guaranteed side of the ledger. And the reason for that is because dividends, the way that those are accumulated, the way that those are paid out is that insurance companies will take in premiums, they'll pay out any expenses, they'll pay out death claims, and then they take in investment returns. They net all that stuff out. And then what they do is they'll go and they will pay out the profits to all the policy owners that have a policy with that company. And that distribution of profit is called a dividend. And so that dividend can and will change over the years. So even when you look at an illustration, it says non-guaranteed on it, but that dividend column is the only piece that can really move on a whole life illustration. It's going to go up and it's going to go down over the years. So if you guys have a good understanding of that, the way that I will typically communicate the rate of return on a policy to a client is we are always very careful. We always try to say around 4%, is because you've got the guaranteed or that reverse amortization schedule, and then you've got a dividend that can and will move over time. And so it's never consistent. It's never static. It's going to fluctuate a little bit over the years. And so if you just assume that your policy is going to go right around that 4% number, you're going to be in really, really good shape. And if you go in there and start digging around on year-over-year growth, you're going to be happy with it, right? So that's a big concern. That's one of the big myths that I hear perpetuated out there. And I hope that explanation clears up a little bit for you.
Okay, Cameron, good job. I mean, that might have breaken the top 3.
Wow, that's a compliment.
You're right. And well, my compliments to you are backhanded. So remember, I'm going to come back.
I'll take
it.
I'll take it. Yeah.
What I really liked what you said, it's the reason why, like, the individual says 10%, it's misunderstanding. And I will tell you, and part of that under this is where they're getting the 10% is that the guarantee of 4% and the dividends are 6. And so they're adding those two together to get 10. The problem is, many problems. Okay. For one, that 4% is a gross number on the guaranteed side. when you were to, that's before before cost of insurance. And I would tell you, to be honest, there was a couple of years where that's how I got taught, right? That it was a guaranteed 4%. Yeah. And that's what message we were sharing with people until we kind of stop taking what everybody said as gospel and started proving it for ourselves. So really that 4% is overstated itself. But in addition, what a lot of people don't know, that dividend is 6 or whatever that number is, that's including the guaranteed. So it's not both. I mean, the guarantee is already part of the 6. So Cam, great job. I think that might be 3. I mean, there's no way I'd give you up to 1, but well, that was good. I wish.
Well, let's see if you can.
That was good.
Let's see if you can crack the top 5 here. Anthony, share us. I don't know, what your second or third one? I forgot.
You're right. It's a second one.
Yeah.
Okay. And my second favorite myth about infinite banking is when someone says, hey, they're only doing that because of the high commissions. Mm. And when somebody says that, that's a signal they don't understand infinite banking. Now, and where they're getting it from is more of typical whole life. And our design is not typical whole life. And if you were to put the same premium on an infinite banking policy and then go to a typical financial planner and do that same premium on a whole life policy, they are going to earn literally 2 to 3 times more in commissions than we are. You have a heck of a lot more death benefit, but no cash value for, really till you're 3 or 4. The way we design it, you have less death benefit. However, you're going to have cash value immediately. And what really irks me when a typical financial planner says this, for twofold. For one, again, they don't understand infinite banking. They're thinking it's more of the typical whole life. But also, if you really want to get in the weeds and compare to the commission a financial planner makes to what we make in our design, to be fair, that even though the way we design it, we're taking a hit in the commission, that first year, if we were just to put, say, whatever premiums you wanted into a policy or make those deposits into an investment account with an advisor, the first year, we're going to make more money than he or she, right? We get paid dollars in the first year and then pennies every year after that. But that is only on the premium. The typical financial planner, their fee is based on assets under management. So they're charging dimes on your total balance. So each time you make a deposit, your overall balance is increasing. So our commissions start off a little high and then drop down. Theirs are actually compounding, and each year is getting more and more and more.
So we got 6, right?
Well, we've got 4 so far.
Yeah, I'd put that at 7.
Oh, now that was a good setup. Yeah. You got me.
All right, so let's go back to the top 3. Right.
Okay.
This is my third one. My favorite myth on infinite banking, and actually, Anthony, it's a twofer.
Twofer. Let's go.
Twofer. A lot of times, just people here out there. A lot of times, you'll hear people out there say that infinite banking takes too long. And the too long usually refers to too long to access any cash value. And number 2 is too long to build up any cash value. Both of those are not true, right? I guess they'd be relative, right? I guess to be totally honest is because what's a long period of time? But typically what I would tell you guys is that when you make a deposit into the PUA section of the policy, early on, when you initiate a policy, right? You start it day 1. You make a payment into the PUA section, you can turn around and you can request a loan against that 30 days later, right? So really that's the only time that we have any sort of restriction on when we can request a loan is when we initiate the policy. And that 30 days is really just a courtesy to the insurance company on the administrative side. Make sure they get everything set up. So rather quickly, you can access and tap into the cash value to turn around and take a loan. The other one is you often hear people talk about it takes too long to build up cash value. There's a million different ways to design a policy. And what I would tell you is that sometimes, right, if somebody's contributing a few dollars, right, on a monthly basis, it can take a while. But we have many designs and many clients that have come in, dumped a whole bunch of cash into the policy, and we're able to access that immediately. And so what I would tell you is it completely depends on the policy design and the fit for that client. So again, too long in regards to the buildup and too long to access it, I would tell you that it actually isn't, right? So hope that helps.
No, Cameron, you have some good ones.
Yeah.
I mean, you've nailed
top three.
I would say 3, 6, and 7, or 3, 5, and 6. Yeah, you nailed 3, 5, and 6. Okay.
All right, Anthony, let's round this thing out. What's your third?
I tell you, this one is I am passionate about, and that's part of what we're doing is one of our favorite ones. Yeah. But my third favorite myth about infinite banking is the insurance company is going to steal your cash value when you die. Now, again, this is a sign whoever says that doesn't know what they're talking about. Okay. And what is one thing to keep in mind, first off, we only deal with mutual companies, which means they're owned mutually by the policyholders. They're on our team, right? This isn't like Geico or your homeowner's insurance or your health insurance where you're always battling claims. We are on the same team. They're not going to steal money from the owners. And if we go back into the history, because with a lot of myths, there's typically maybe like an ounce of truth, right, and a pound of lies. And where this started is typically with universal life policies. They give you the option, right? Now, universal life typically has a 1-year term insurance and then a side fund. Maybe that's invested in options or mutual funds or an interest-bearing account. And with there, everything is broken out. So you have the option. You can say, I want the death benefit and my cash value, or I just want what the term insurance has. But what is interesting, those options have different prices. And in part, if you're going to get both, then there's more risk for the insurance company. So the cost of that insurance is going to be a little bit higher. But what I want to look at is let's look at the numbers and kind of analyze it, because I'm going to tell you, not only is it a myth, but you're going to want that death benefit, not the beginning. You're going to want that final death benefit as opposed to that initial death benefit and your current cash value. So let's take a look. Okay, what I want to do is actually show you the numbers. If you're watching this on YouTube, we're going to share the screen, but if you're listening to the audio on the podcast, I'm just simply going to walk through it. And I'm going to round these numbers. Again, if somebody says that the insurance company is stealing your cash value, again, they don't understand it, because like Cameron had said, the cash value is actually part of the death benefit. And if you go out to whatever the level of the year of maturity, whether that's 100 or age 121, what you're going to see is the cash value is going to equal the death benefit. So on this illustration here, we can see the cash value is 8.1 million at age 121, and the death benefit is the exact same number. Okay. But to really get to the point, I'm going to show you that what you really want is that current death benefit, not the initial death benefit plus the cash value. Because if we dive a little deeper, if we were to look at this example policy, the whole life death benefit from the beginning, it's 466. Let's just round it to 500,000. Okay. So your initial death benefit is 500,000. And let's say you live until 70. Now at 70, that cash value, let's round that to 1.2 million. Okay. So kind of like Dave Ramsey has said this multiple times, right? But let me ask you this, Cameron. Would you rather have the initial death benefit of 500 and the current cash value 1.2? So a total of 1.7. Or would you rather have the current death benefit of 1.8?
I'll take 1.8.
Okay. So, and as we've established here, I believe, Cameron, you're not a CPA?
No,
right?
Believe it or not.
Okay.
No.
Cameron's not a CPA, but he still understands this, right? 1.8 is bigger than 1.7. When someone is sharing these myths, I mean, that is a sign. I mean, look, we want you to get understanding, right? Don't take our words for it. You need to do your own research. But when somebody says something, do their own research to what they're saying as well. And oftentimes we have to realize this is not whole life. This is infinite banking. So the product we're using is different than what they're assuming, and how we use it is going to be different than how they are assuming.
Well done. Good point, Anthony. Good point. I'll give you top 5 on that.
Okay, good.
Yeah.
Actually, I would say yours were good, and
top 3.
I was impressed, and I think I need to stop being so surprised. I think I still remember little Cameron, putting you under my wing, explaining what a PUA is. But man, that was a long time ago, and you have grown. And I need to kind of realize you've grown, and that not better than the teacher, but right, you have grown, and I'm not giving you the due respect.
Again, just a backhanded compliment.
Yeah, this was a backhanded compliment.
Yeah,
I told you, if you get one from me, get a compliment, be careful, because the backhand's coming.
There's more to come. Awesome. Well, I think I'd like to say thank you for that compliment.
Mm-hmm. You're welcome. It was my pleasure, Cameron.
Yeah, and thank you to the listeners for sticking around. Hope you guys enjoyed our top 6 myths referred to infinite banking concept. There's a lot of misinformation out there. Make sure you guys are coming here to get the truth on infinite banking.
Go make it a fantastic day.
Take care.
If you like this video, I know you're like this one. And if you want to learn how investors use infinite banking to increase their returns and lower their taxes, check this out. And if you have some questions and want to see if infinite banking is for you, hop on a discovery call with us. Link for that will be in the description.